guys? Welcome back to the Capital Mindset Show. Today's going to be an update video on Meta platforms. Okay, so for those of you who may not know, we'll cut right down to the chase. The stock price has actually collapsed. And in the last video of Meta, I kind of said, I think I forgot the timing, but you guys can watch that video. I did say that about around 250, the stock would be quite interesting. And now it's at 243. So the question now becomes, is it interesting? And I'll say this. I'll cut to the chase, no bearing the lead. It is interesting, all right? It has fallen enough to where I'd say, I barely even got to nibble. And in that video, I said I would start nibbling into Facebook stock or Meta stock. There you go. I did it again. And here we just entered perhaps the bite range, right? And then the gulp range is like 200 and below. So that would be when I transformed, or the position could feasibly become a very large position within the portfolio. But at current prices, it's definitely within the bite range, unless I see something's really changed. And we'll take a look at the new information that came out, kind of discuss it, whether or not something crazy has occurred to change the thesis behind Meta or increase the risks. Okay. At the very least, the market is telling us that you don't get a price down of 24.74% in a single day for a company like this unless something is afoot. Okay. So now the market cap is about 674 billion. Just the other day it was in the 800s. So now we're seemingly getting a much better price. And, we're going to take a look at that. So let's actually go to their report here. And here we can kind of talk about a little bit about what's kind of going on. So they did experience really good growth, but I'll actually get into the problem with this growth. Okay. So the growth was 20% year over year. And so, that's all well and good, right? And in the year ended, right? So that's a 3-month. The year ended, it was actually almost 40%. So quite significant level of growth. So congratulations to Facebook. You managed to grow the company by quite a lot. Now that growth, maybe we can think about it in a couple of ways, but maybe that's, pulled forward a little bit. And then that will actually get into the segment, which I'll get to. I think it's, right here. So they expect revenue to grow going forward at about 3 to 11%. Year over year. Okay. So that's significantly lower than the 40% we were just seeing, right? So there's two ways of looking at it. They may have pulled forward a lot of that growth, or as they're saying here, and they're kind of warning you, there may be some significant changes to the Apple iOS system that has changed the engagement or the accuracy of their advertisements. And so remember that Facebook, its primary business is advertisement. It's an advertisement company. It's a software. It's an application. It's a platform. But all it does is advertise, right? And it's very effective at what it does. So I do see that iOS, those changes will have an impact, and the business does say so as well. I think they say somewhere in this document that it's about a $10 billion impact to the business, just a single update to iOS. So again, management likes to throw in perhaps worst case scenarios because they want to cover their tracks. Okay. So you have to keep that in mind as well. And they may be kitchen sinking it. All right. So that's something for us to also consider. They may be kitchen sinking it, or they're just, they're being fairly on point and accurate. Right. So they do say in 2022, they expect the expenses to range in 90 to 95 billion. This is where we actually start to get to the crux of the problem. And the problem is, or from the market's perspective, Facebook is spending tons of money. They're bringing in lots of money, and then it's just going right out. So we'll actually get to their cash flows and kind of discuss that, but yeah, that's basically what's going on. So they're investing heavily in a bunch of different projects. So for example, we have their labs division, which is basically a pre-revenue business, not really making anything in relation to the rest of the business, right? They're still mainly an advertisement business, but yet they're spending a lot of money in that category, right? So here we can kind of see the beginning of it. So they're spending a lot of money in research and development. And so that expense is growing, okay? It's growing quite rapidly. And this is a quite a serious amount of firepower that Facebook is throwing in to R&D. 24.6 billion US dollars. That is larger than a lot, or maybe even most businesses statistically. So for example, another company that, is somewhat in this space is something like Dropbox. Well, Dropbox the entire market cap is about 9 billion, and Facebook is spending 24 billion on research and development. Okay, so we're going to see what they come out with that. Of course, they have competitors. Again, we've covered one of them, Google, which Google on this news doesn't really care too much. It was down slightly, and then it's pretty much phased this off. And Google had a fantastic quarter when compared to Facebook, because Google, in my opinion, as a company, is a little bit more premium, but it's priced for that. Okay, so it's not that it's any cheaper, right? It's priced for that premiumness. Okay, so here we're looking at Facebook. Not that Facebook's bad business, by the way, by any stretch of the imagination, but we have to understand that going forward, Facebook's going to be investing a lot, and that reduces the cash flows, right? Because that is cash that's going to leave and not come to us in our pocket. But we have to understand that that cash generates future returns, okay? So, or it might. And then this is considered to be maybe a high cost or high risk, high reward scenario for something like Facebook, okay? So where they're investing a lot into these different new technologies, but we have to see them bear fruit into the future, and that's an if statement. That's not a statement of fact, okay? So you can kind of see here that net income is actually coming down quite decently. And then we can kind of take a look at why that is. Well, you can see right here, research and development increased quite drastically. Already in just that increase alone, that accounts for the difference here in more. Okay, so I can kind of point to research and development as being the main culprit here, and that's a good thing. Okay, we want that. Their interests. Interest and other income. So because they have marketable securities, we'll kind of talk about that in their balance sheet. But yeah, for the most part, we can see the income from operations is down just right here. So this is the bottom, taking into account everything else. And that's because you can see the expenses has gone up, right? Despite the revenue going up, the expenses has gone up more. And then where is that actually showing up? It's showing up in R&D. It's showing up in the marketing and sales. And then this is, you can think about it like the security of the actual platform, but this is going up slower than this. Okay. Or wait, no, actually, no, this is actually going up faster. This is going up faster. Sorry, brain fart. Because we can do some quick maths to actually check that in real time. So if we just take the difference, right, between, so 33 minus 28, and I'm just rounding, guys, to give a rough estimate, divided by 28, we get a growth rate of about 17% there. And then let's take a look at the other one. So let's round that to 6 and 5. So yeah, I already can tell that's going to be 1, 5. So that's already 20. Yeah, 20% increase. I don't need the calculator for that. So about 20% increase in cost of revenue versus the 17% in revenue itself. So that's a lack of efficiency. So basically they're growing faster their expenses, but they're investing in their security or whatever, stuff like that. Nothing to be really concerned about, but the margins are compressing in that aspect. So taking a look at the net income for diluted earnings per share, we can kind of see here that the 2020 numbers were higher despite the buyback. So the buybacks aren't really doing much because the buybacks aren't really that significant. We'll get to that in the model. And share-based compensation expense. So of course they're paying their employees like that. So it's about 2.4 billion, 1.7 billion. So they're paying their employees more in stock-based compensation, probably because they want to retain more talent. I can speak a little bit about this. For my wife, for example, she almost worked for Facebook. She took a job somewhere else instead, but she almost went to work for Facebook as well, I won't even say the role, but the point is, what I'm trying to get at is that they're hiring a lot. So yeah, they're trying to actually increase their headcount by quite a bit. I just know that. All right. And taking a look at the cash or total current assets, it's actually down. And this actually, you can kind of point to them expensing more things. So they're spending more money on, again, R&D and stuff like that. So marketable securities, I told you that it's there. So they actually drew down the marketable securities. This is them holding like bonds, for example, basically liquid assets. That's why it's in the current assets. So current assets is everything that they hold within 1 year. Or that they can readily liquidate basically within 1 year. And look at that, there's a lot of sixes. But yeah, this is coming down, right? So total assets is going up, but again, current assets is going down. Okay, so I'm explaining, hopefully that makes sense why that happened. All right, let's take a look over here at the net income. So basically, or the income statement, sorry, not the net income, the income statement. Net income again is down, and we've already explained that up above. So the cash flows is what really kind of matters, but the cash flows are actually up. And the reason why the cash flows are up but the net income is down is because we are taking out some non-GAAP net income expenses. So some of the things that should be taken out, yeah, share-based compensation, that's taken out. Depreciation, amortization, that's taken out. So really, I consider this to be an expense, but there is something to be said about that. Okay, but it's not a cash expense. So that's pretty much that. I mean, we also have to consider the buybacks that they did, but the buybacks I think had a net positive impact on that effect. But it's near here or there. All right, so accounts receivable. This had a negative impact, and then prepaid expenses. Okay, so that's pretty much it. I just wanted to cover that this is going up, but also this is going up, and I think rough math, they're going up close to about the same, almost about the same. There might be a slight difference in either one, but they're going up about the same. Okay. 12 months ended, we look at the same picture. It's actually a drastic increase. So it's actually at 57, which actually I'm going to make sure that the model is completely up to date because this is from Facebook itself and it's not porting in. So I'm going to make sure before we actually do our calculations what that is, and then I'm going to apply the new growth rates because they do say we're going to be conservative and we're going to lower our growth estimations from the last video, and then see what kind of goes out. And I'm going to create a plan for myself to think about how I'm going to play this stock. All right, so free cash flow, we already know we don't need to cover this, so that's pretty much it for that, guys. So let's actually have a quick discussion, I guess, about the risk play here. So again, we know that engagement is going down. The management has talked about the competition growing between other platforms. So for example, TikTok or Snapchat, all these other things. YouTube is actually a competitor to Facebook. Anything that draws content or eyes away from their services is a competitor. Okay. Now that doesn't mean they can't all succeed. They very much can all succeed. Instagram is pushing a lot into Reels, for example. And again, we have the untapped potential of WhatsApp. So I do think WhatsApp, for example, can become a huge payment processing platform in the future, something akin to, Venmo or Cash App, but kind of like the international variant. Because if we think about it, well, I mean, if my audience who are American, how many of you use WhatsApp? Probably not very many of you, unless you have an international background, like, for example, your family's from a different country, because internationally, WhatsApp is widely used everywhere, and even Messenger is used widely as well. So when we take that into consideration, that they're not really monetized at this moment, and all the potential for future services to be added to such platforms are abundant. There's many ways that Facebook over time can, or sorry, did it again, Meta can profit or eke out some profits. And then we're not even considering the potentials into augmented reality, et cetera, and stuff like that. I don't want to consider that. That's kind of like the call option on this business. So we need to basically account for these risks and pay a fair price. Facebook, this has happened to Facebook in the past, all these challenges. And typically Facebook is a company that has proven to be capable of overcoming them and surpassing them quite drastically. We want to make sure, for example, that the company is nimble enough to adapt to the certain changes. And when companies become very bloated, it's very difficult for them to make the proper adaptations unless there's some serious changes in management, et cetera. But, I think Facebook is that still, but that may change. And again, if the facts change, I'm completely capable of just completely changing my mind, by the way. So I went over this completely open to the fact that perhaps the story is changing with Facebook. However, I kind of came out of it thinking the story has changed, but not in the way the market is handling it. Okay. So perhaps, and then we'll actually get my emotions out of it and then look at the model, look at what it tells me. And then I'll kind of, again, scrap a plan. So I'm going to skip over some things. I won't go over everything. But I'm pretty much going to I'm not going to go over the key ratios because again, we can go back to that old video for that. So I won't waste your time with that. So let's take a look at Facebook. This is basically exactly where we left off in the old video. So I haven't changed anything. And now this is updated for the new price, about $244.13 as of the filming of this video. And I have at the moment a discount rate of about 15%. So applying a 50% margin of safety. Let's lower it to 12% for those of you who want to see the lower discount rate. and pretty much at a discount rate about 12%. This company actually looks extremely cheap relative to where it's at right now. And we can assume very low growth rates. I mean, let's see what we can actually get out of this. So I think 7%. Oh, okay. No, not 7. We can't go that low. But yeah, basically about 8% and above is what we'd have to assume from the business. And then we could expect a reasonable 12% rate of return. Now, that's not anywhere near what Facebook has performed in the past, because a 12% annualized rate of return implies a 210% upside over the course of 10 years, which is the long-winded answer of above the market average over the long periods of time. And again, market average going forward might be a little bit less than the historic 10% because of the current valuations of the market. So keep that in mind as well. So 12% might actually be a big outperformance. Might be, but that's not a conversation in this video. Okay. So if we go back to our 15%, we definitely can't assume anything that low. We probably can assume maybe a 13% growth rate. Yeah. So we can assume 13% and above, somewhere in between 12 and 13 to be precise. And then we get our 15% rate of return, which is 50% margin of safety, or you could think of it also as 50% greater return than the market on average. And that would be about 304% over the next 10 years. Okay. So not too bad. Now, will they grow at 13% rates of return? I think they're capable of it. The sales probably won't. The revenue probably won't. The GAAP net income probably won't. The cash flows maybe per share, especially if they ramp up buybacks, and they might do it now. We might see an announcement here soon that they're going to do that. What we want to make sure, though, is that their ROIC is really high. And remember that they're investing a lot of capital back into the business. So the ROIC can help us as an indicator on how effective they are at reinvesting that capital. And we can see here that they're reinvesting that capital at 26.85%. So I think that they should probably keep doing what they're doing. Okay. That's what that number is telling me. And so I have confidence that their investments may bear fruit into the future, but just based off of the legacy platform or the legacy brands that they own right now, it is a compelling price. Okay. So I have added, just so everyone knows, I boosted the position up quite nicely. So I boosted it about, I think, 12% today. And so, and I think I'll be boosting it or adding for the next coming days, right? Because I want to actually bring it up to size. I was nibbling in the 300s, and I didn't even really buy that many shares, which ended up in hindsight working out perfectly. I love when things work out just like that. It usually doesn't work out this way, but sometimes the market just gives you these opportunities, or gives you these moments in time where you're like, okay, sure. So I'm picking up some shares here. And then again, I'm going to be very interested in this business if the pessimism continues. And again, I always strategize of entering into stocks this way or adding to stocks this way. I create ranges. I don't have a set price. I just create ranges. And then I don't care if I don't get the full position in and it just skyrockets from there. Because I'd rather have more firepower going on the way down than missing out on that. And then I'm not in any rush because there's always new opportunities, right? So I'm telling you guys right now. So right now I'm kind of biting. So I'm buying larger chunks than before. And then my plan is, as it approaches 200, if it does approach 200, those purchases will get larger and larger and larger. And then it will have a maximum allocation of, I think I have it set to about 10%. So maximum allocation of the portfolio it will reach in my current plan is about 10%. Maybe it would get up to 15%. It just depends on the price that we receive. I just don't know if it's going to get there, but right now that's the allocation strategy. Okay. For example, the model right now tells me at the current assumptions and everything, and I say all these scenarios are equally plausible, it's actually still only telling me to put in only 2% of my portfolio into this investment, right? And then that's just the model's opinion. I don't always take the model, as word for it, but it's like a good little indicator. Okay. So they might, again, ramp up these buybacks. So let's say if they did, for example, 2%, that of course changes the numbers. And I think our minimum threshold is actually quite close. Let me see if it's 11. So it's about 11%. if they raise those buybacks and they are able to purchase more shares and lower that share count. So that would be an interesting moment. Okay. If I wanted to discount it at 20%, this is again where my prices are coming from. If you guys are wondering where the heck is his $200 and below price coming from, it's coming from a even higher discount rate. So then I have that strategized in such a way that at that point, I'm getting a very good margin of safety in my personal opinion. So for example, if for some reason we get very pessimistic and then the macro backdrop is really bad, for those of you who, again, do not know, I'm actually quite heavy in cash right now. And to answer everyone's question, I think I've addressed this already in another video, but I am not liquidating my Google at the moment to buy Facebook. I don't want to incur those taxes at the moment. And I'm going to kind of wait because I'm going to do a call option strategy. I'm going to see if I can actually do that successfully once the split happens. I'm not going to do that yet. And I never did that before because the volumes were, it's a hefty stock, right? I didn't want to do that. But now I'm going to be able to do that more, right? It's going to make a little bit more sense. I'm going to see if I'm going to see if it makes sense. That's what I'm trying to say. I'm going to see if it makes sense. And I'm going to do that, but I'm not going to sell Google to buy Facebook at the current moment because I just have a lot of cash sitting around, and I don't need to add to my cash pile. I don't want to do that right now. So what I'm going to do again is I'm adding Facebook here. I was nibbling. Now it's in the bite range. And then if it gets to 200 and below, that's when I start adding more heavily. My allocation strategy is to get up to 10%. But yeah, I think at that point, it'd be a very good risk reward for me, right? Maybe not for you, but for me, it would be. That margin of safety, I'm kind of looking forward to that. And I hope the market actually provides that. We might see that because again, of all the things I've been discussing that in the macro backdrop of the United States. So that's pretty much that. If you guys have any questions about anything I discussed in this video, I know I didn't go over the key ratios because that's, it's pretty much the same, guys. But if you have any questions on anything I went over in this video, go ahead and drop it down in the comments down below. I think this was a interesting update as far as for me. So looking into Facebook's books and their numbers, I don't think much has changed, but definitely some things have changed. So some added risks have come up. So the previous price points in the 300s, we need to see some of those addressed before I think the stock should be ever trading at those levels again. Can they do it? Absolutely, they can do it. They can address those, but that's a wait and see. But that's the point of investing. We have to judge the risk reward and then make educated decisions as to whether or not we want to participate in a business. And so this is one I'm willing to participate in more now than before. And if it goes down lower, even more, I want to participate even more. And I think it actually, in the filming of this video, it went down almost another $2. Okay. So on that note, guys, I'll see you guys in the next one. I hope you guys have a great one. Bye.